Hi, this is Todd Baker, your certified mortgage planner, and in this video I'm going to discuss debt ratio, also known as debt to income ratio, and what it is and how it works so you can understand. It's super important that you understand how this works so that you don't accidentally mess up your ability to buy a house. There's financial planning implications that no lenders are going to tell you, but I will because I'm a trained professional and certified mortgage planner. So first, how is it established? So when you're qualifying for a home loan, you're going to go off of gross income. So that means we need to know what gross income is. And gross income can be very easy or very complicated depending on your situation. So for example, if you're on an hourly rate of pay, you can go off what's called base income. So it's your hourly wages times 40 hours a week times 52 divided by 12, and that's your base monthly income. However, that has to be if you're on your pay stubs have to show and your year-to-date income has to show 40 hours a week. If you work variable hours, then it has to be averaged. In addition to that, if you have overtime or bonus income or commission income, that's considered variable income. It also has to be averaged, and that cannot be determined just by pay stubs. So when you get into variable income, you have to do a full written verification of employment. And I can tell you right now, 99% of the lenders will not do that. They will base your loan approval off simply what you put in the loan application, which is most likely going to be wrong in terms of how it's actually calculated. Another example, salary is easy. Let's say you make $5,000 a month. That's easy. That's your salary. If you get bonus on top of that, you can average that out. The average is always going to be for 2 years. There's sometimes only one depending on the situation, but typically it's 2 years. In other words, it's one if the bonus goes down, you can still use it, but you average it for 12 months rather than 24. When it comes to income for self-employment borrowers, it goes off of, if you're a sole proprietor, it's off your personal tax return. It'll be on your Schedule C. If you're a corporation or an LLC, and there's two different kinds of corporations, then that income will come. You have to have business tax returns as well. So then you need personal business returns, and there's a cash flow analysis that gets done. So the bottom line is you first have to determine what's your qualifying income. Okay, once you have that, your debt ratio is going to be the percent of your monthly obligations of that gross income. And that includes the housing payment, which is principal, interest, taxes, insurance, and any mortgage insurance premium. It could be, if you have other houses, potentially what your net, that could be income or it could be a loss. But then usually though, for most people, it's just going to be your housing obligation plus whatever is also on your credit report. So that could be, it's your credit cards, your student loans, your car notes, etc. Now, it gets even more detailed than that. If you have student loans, there's 4 different types of repayment plans, and there's deferral. So really, these are 5. They can be in deferment, or they can be on standard, extended, income-based, or graduated. And so that's a whole nother video, really. But a great lender has to determine up front which type they're on, because there's rules on what you can use. Some loan types go off just what's on your credit report. Others you have to verify, like for FHA, you have to verify that it's actually in a standard or extended fixed payment and use that. Otherwise, you have to use 1%. Sometimes you have to accommodate a certain amount in the debt ratio for collection accounts, certain kind of collection accounts, like non-medical collections. So it gets complex and it needs to be done correctly. But that's how your debt ratio, and that debt ratio is important because that'll determine your purchasing power, what you can qualify for. Each loan program has a maximum debt ratio on, number one, what percent of your housing payment is of your income, and number 2, what your overall debt ratio, which is your housing payment and the other obligation, is of your overall income, to determine if you can qualify for. On top of that, there is a good standard financial planning percent that you should use, and that's 25%. So a good benchmark is 25 to 30%. If your housing payment is of that range of your actual income, that is a very comfortable payment that will allow you to continue to invest in short-term emergency reserves, long-term retirement, vacations, and a balanced lifestyle. If you go too high in your housing payment, you will be what they call house poor, and you'll end up selling the house is what will happen. You'll end up not being comfortable, not being happy in the house. So it's, once again, important to work with a trusted advisor. So debt ratio becomes a critical thing. And then last but not least, once you're pre-approved, you don't want to go out and acquire new debt. What happens is credit reports are good for 4 months. And then if it goes beyond that, we have to repull credit. And then also, lenders have to repull a soft pull right before you fund, and it'll pick up any new liabilities. So like I always tell my clients, don't acquire any new debt. Don't do anything without checking with me to make sure it doesn't impact your debt ratio. So that's a deep dive into debt ratios. Hope you find that helpful. And as always, please feel comfortable reaching out to me with any questions. Have a great day.